With the recent rout of commodities, the question that most investors have asked is whether the rally in commodities is over. Silver had fallen 31% and WTI crude 17%. This is the biggest fall since 2008. There had not been any strong factor that can be attributed as to the cost of the fall in prices. Commodities markets have been severely overbought. Exchanges had imposed higher margin requirements. A routine report on US weekly claims for unemployment benefits showing the US labor market to be in a worse shape than expected had spooked investors. Then the European Central Bank surprised traders with a more dovish statement on interest rates than was expected. As a result, the dollar rose and commodity longs started taking profit. Volatility increased, technical levels were breached, stops were triggered, and panic selling crashed in. However, we felt that the correction in prices was overdone, and likewise, some investors jumped in for bargain hunting, as reflected in the increase in open interest. Fundamentally, little has changed in terms of commodity drivers that were pushing markets higher. Generally, demand is still expected to be strong and supply constraint remain, with ending stock historically low for most commodities. The setback was a reaction reflecting the growth concern due to Japanese earthquake and the problems in the MENA region. For example, the structure of the crude oil market is still bullish. Some steam has been taken out of the rally in crude oil prices, but I see it as a positive short-term correction, more of a pause and a cleansing of excessive speculation. WTI frontman is well supported at $90 a barrel. Given the short-term strength of the US dollar, we expect some short-range trading above $95 before this oil market gathers enough steam to push higher. There are, however, some commodity markets like the grains and oilseeds that were not excessively affected by the rout. The traders looking at corn, wheat, and soybean futures markets are paying more attention to demand and weather issues than macroeconomic factors. Investors saw the recent dip in the market as a buying opportunity. The corn market, for instance, has rallied back to the trading range before the rout. We have concerns about the weather since the planting progress of corn in the US to date is 8% behind the 5-year average. Thus, we see that a strong buying interest would come in at $6.70 a bushel for July corn if the market dips to this level. If the weather deteriorates further, we can see July corn trading above $8 a bushel. The weather is also playing havoc with the wheat market. The excessive dryness in wheat growing areas of Europe has driven the milling wheat prices to levels last seen in 2007. Although concerns about global supplies are easing, as rain is expected to fall in Germany and France, a let-up in the weather would present a buying opportunity, with live milling wheat expected to touch €260 a ton near term. Traders can also look to buy the live Paris milling wheat contract and sell the soft rate wheat Chicago CME wheat to hedge their bets. However, not all commodity markets are bullish. The forecast for the sugar market has turned from being in deficit to a surplus, and this has weighed down prices. This global sugar surplus is expected to surge further in 2011-12 by 5 million tons from a previous estimate. Thus, we look at rallies in this market as selling opportunities.